This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Welcome to the American Monetary Association's podcast, where we explore how monetary policy impacts the real lives of real people and the action steps necessary to preserve wealth and enhance one's lifestyle.
Welcome to the Mortgage Minutes for this month. We are joined today by one of the lenders from Jason's network. And what are we looking at out there in the mortgage market?
So right now, the market has been moving in our client direction rate-wise. We've seen that really since the beginning of the year. The market is probably down, or the rates are probably better by a good 3/8 to half a point since prior to the new year. So that's been a very positive downward trajectory for us as it relates to mortgage rates and for all of our investor clients who are looking to acquire new properties, but also for those who are looking to take some equity out of their homes. They are getting the opportunity to refinance to a slightly lower rate than they originally had.
We hear about the coronavirus. We hear about all this stuff going on. How has that been impacting the bond market?
Well, with the onslaught of the virus, what we've seen is a little bit of panic in the stock market as it relates to that. The stock market kind of weakened a little bit last week. Our bond market improved on that, so therefore mortgage rates went down. So anytime you've got some money flowing from the stock market into bonds, it's more of a safe haven for investors. Our bond market, our rates are tied to the bond market. So typically our mortgage rates would improve a little bit as the bond market does better. Now, as of this morning, Friday, we saw a large hit to the stock market on the fear of the coronavirus spreading and even causing somewhat of a pandemic globally. And then yesterday was kind of a mitigated a new day. There wasn't much going on. But today, this morning, we've seen the stock market jump over 450 points, and they've regained all the losses that they took last week. And primarily because the Bank of China has begun to prop up the stock market, and they've come in and they've started buying billions and billions of dollars worth of stock as of today. So, we're seeing some reaction to the stock market, with the Chinese coming in and saying we can control any potential pandemic here as it relates to the coronavirus, and we're not going to let our stock market or even global stock markets go unsupported. So what they've done is come in with, I believe it was over almost $400 billion worth of stock purchases today. So the market has rebounded, and it's almost like the stock market is not too concerned now about the coronavirus.
Interesting. With good credit, $100,000 house, 20 or 25% down, what rate roughly would they be looking at?
Let's say $125,000 purchase, the loan amount's $100,000, that's 20% down. My rate today there for that client with excellent credit is 4.75%. You might even get to 4.625% on a good day. Now, if you the same purchase price and you put 25% down, same credit profile, we're looking at 4.125 as a low in the market, maybe even 4.25 depending on the day. I would say overall 4.625 for 20% down, 4.125 for 25% down. Both options with no points. So these are rates. These are as low we've seen in rates in some time.
So with the 25% down, if someone paid points, is it possible that they're looking at 4% or even lower?
Oh, sure, yeah. 25% down, paying a point would likely get you down to somewhere around 3.875 or even 3.75. Now, you might pay 1.1 or 1.2 and go to 3.75%, but that's definitely a viable option.
Wow, so that's getting down into like primary residence rates at that point.
Yeah, so when we look at those options and we work out the numbers for clients who are interested in paying points, what we need to do is look at what the break-even point is for that expense or for that additional cost to buy down the point or buy down the rate. So generally speaking, we tell our clients if you can break even on the cost of paying points in 2.5 to 3 years, then it's likely worthwhile simply because this is a new 30-year fixed rate mortgage. It's long-term debt. The assumability here is that you're going to keep this property for a long time. And once you can break even in 2.5 to 3 years on the cost of the point on an investment property purchase, when the loan amount's less than $100,000, it generally makes sense to look at paying points and take the lower rate long term.
How do you think, China's coming in and propping up their stock market? Do you think that's going to improve sentiment enough that our rates will start going up a little bit, start edging up?
I don't think so. I mean, you're always going to have fluctuation in the market. It never moves in one direction in a straight line. I think overall for 2020, most folks within the real estate industry, from builders to realtors, the associations of all these departments are cogs in the wheel, so to speak, in terms of the industry, lenders particularly. Most economists are telling us that, we predict 2020 to be a relatively stable year in terms of rates. So we don't particularly see the market moving half a point or 3/4 of a point in any one direction. But you will see your daily fluctuation in the market of 1/8 of a point or 1/4 of a point continue, because that's quite typical as the market moves up and down and factors come in to affect the market. But overall, throughout 2020, the general prediction across the industry is that rates will remain relatively steady and not move in any one direction, too high or too low.
So we're looking at rates 5% or less, most likely for the rest of the year?
I would imagine so, for 20% down, depending on the credit profile, of course, to a certain degree, the loan amount. Yes, we're looking at probably 20% down below 5 and 25% down certainly below 4.5.
Oh, wow. That's really great for us. Is there anything else going on in the market that looks like it might be impacting us moving forward?
Well, obviously we have an election year, so generally speaking and historically speaking, whenever we have an election year, our market rates tend to be relatively steady in an election year, short of anything crazy happening geopolitically. So for the most part, we are anticipating, that being a factor in keeping our rates relatively steady as well.
All right. Is there anything else you think is important for the listeners to know?
No, I just think that now it's still a great opportunity to grow your portfolios within the turnkey industry. It's growing every year that we've been involved in it. It certainly has gained some attraction among investors. So finding the right partner and finding the right inventory is important now as ever. So if there's anything we can do in that regard, please let us know. And obviously, Jason's team of investment counselors can point you in the right direction.
And one thing I realized I forgot to ask, mortgage starts for your company, how have those been increasing, decreasing, holding steady? What have y'all seen there in terms of applications for mortgage starts? Have y'all
for the turnkey stuff for our world? Yeah, we've seen applications certainly increase. A lot of that has a little bit to do with the decrease in rates, because we're getting some refi volume now, refinance volume. But overall, as it relates to new purchase acquisitions, and our team has certainly grown in January. Fundings and closings in January and applications in January were certainly up maybe about 20% over December.
Oh, wow. And how has the refi market, that as the rates have been dropping, that's becoming more and more popular. What kind of refi market are we looking at right now?
Generally speaking, for the folks who have investment property portfolio, we're refinancing properties that they may have held in their portfolio for some time, and they've had a chance to grow some equity there. They may have acquired the homes at slightly higher interest rates, particularly coming out of the recession. So now they're getting a chance to lower the rate and tap into equity on some of their historical homes or that they've had in their portfolio. The newer acquisitions to the portfolio are still relatively fresh, if you like, from an equity growth perspective. So there isn't a lot there. We're also seeing some folks will refinance, their debt into 15-year fixed rate mortgages, so they don't cycle and yet still take equity out of the homes, so that they don't see, because of the lower rates, they don't see a payment shock to what they're typically paying, but yet they get a chance to pay the homes off a little bit sooner. And again, these are homes that have been historically in their portfolio.
Well, thank you very much for your time today. I appreciate it.
Absolutely. Yeah, anytime.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.